So today, we'll have to finish up with IFRS 16, majorly that. Then we'll be left with, so next week I'm supposed to teach you ratio analysis. Then upper week, we'll probably look at IFRS 8, operating segments, and interim financial reporting. Then I think we are going to review past questions also, and all of that. So what we have to do is not that much. It's not that much. While our Thursday classes, because we just have to continue with that. That will address some minor standards. Because if we continue with just this class alone, it's not possible for us to cover all of those standards. There were a lot of them. And I also noticed that, yes, you guys don't submit your assignments. I think maybe Abidemi, I don't know, I think just her. No other person attempts all of this classwork that we give you guys. So, yes. Okay. Let's do what we have to do tonight, then we'll see what is left after tonight. So we started IFRS 16 last week, and you learned that IFRS 16 deals with leases, and in a lease contract, there are usually two parties, the lessor and the lessee. The lessor is the owner of the assets. The lessee has right to use the asset. And when we said when you have a contract, to identify that there is a lease in that contract, we said you must be able to see that the lessee has right to control the asset. And when we say right to control, I mentioned that it can either be where the lessee has right to obtain substantially all the economic benefits, and also where the lessee has right to direct the use of the assets. These two indicate right to control. We looked at some scenarios to take care of that. We then looked at the principles around lessee accounting. And we mentioned that at the commencement date, the lessee needs to recognize right of use assets as well as a lease liability. I told you that the reason why the lessee is recognizing a lease liability is because right from the commencement date, he has an obligation to pay all of those rents through the lease term. He has an obligation to pay all the rents. And that is why the lease liability is usually measured at the present value of the unpaid lease rentals. Present value of the unpaid lease rentals. While at the end of the year, this lease liability will be reduced with the rent that the tenant is paying or that the lessee is paying. You use that to reduce the lease liability. In addition to that, you would also unwind the discount. You would unwind the discount through finance costs. We're going to add finance costs to the lease liability. For right of use assets, we said that is also measured at the amount at which you measure the liability. But if there is any amount paid at the commencement date, that would be added to the lease liability, to the right of use asset, I mean, to be added to it. And at the end of the year, the right of use asset would be depreciated over the lease term. It will be depreciated over the lease term. And we solved some questions last week. We solved some questions last week on lessee accounting. Today, we solved this question. I explained all of this to you last week. Today, we are going to be starting with lessor accounting. For the lessor is the owner of the asset. He owns the asset. So ordinarily, you would expect to find that asset in the books of the lessor. Since he owns it, so the asset should be sitting in his books. So for lessor accounting, the main accounting issue is that should that asset continue to be in the books of the lessor, or should we derecognize it? That's the main accounting issue. And to resolve that, the lessor needs to understand and identify the types of lease he has entered into. If it is a lease that transfers substantial risk and reward attributable to the ownership of that asset to the lessee, if the lease is transferring risk and reward of ownership of that asset to the lessee, then you would derecognize that asset. But if the lease does not transfer risk and reward attributable to ownership of that asset to the lessee, he will not derecognize the asset. He will still continue to maintain the asset in his books. So the key question is this: which lease transfers substantial risk and reward? That's a finance lease. It's a finance lease that transfers substantial risk and reward. So if the lessor is able to identify that the lease he has entered into is the finance lease, majorly the major accounting issue here is to recognize the asset. But if it is an operating lease, you would most likely leave the asset in his books. However, since for the lessor, the identification of the type of lease or the class of lease he has entered into is extremely important, because that's ultimately what will determine how he's going to account for that lease contract or that lease arrangement. So I mentioned earlier that finance lease is one in which the lessor transfers substantial risk and reward. When we say the lessor has transferred substantial risk and reward, what does that mean? Then that takes us to indicators of a finance lease. What are the indicators that will show that this is a finance lease? Or that will tell us that the lessor has transferred substantial risk and reward. Number one is where there will be transfer of ownership. Where there will be transfer of ownership to the lessee at the end of the lease term. Where there will be transfer of ownership to the lessee at the end of the lease term. This is one indicator that possibly show that this lease is a finance lease, that the lessor has transferred risk and reward. The lessor is as good as the lessor has sold this asset. Where there will be transfer of ownership to the lessee at the end of the lease term. Another one is where the lease term is almost equal to the useful life of the asset. Where the lease term is almost equal to the useful life of the asset. This is also another indicator that no, the lessor has transferred risk and reward. This is as good as the asset is not coming back to the lessor. This asset is gone. Another one is where the PV of lease rentals is almost equal to the fair value or market value of the asset. Where the PV of lease rental is almost equal to the fair value of the asset, that's also an indicator that this asset is not coming back, because the rent he's collecting is almost equal to the fair value. That's like he has sold the asset. He's just collecting money instrumentally. So it's an indicator of a finance lease. Another one is where there is a purchase option. Where you have a purchase option available to the lessee, where there is a purchase, when we say purchase option, we are talking about an option available for the lessee to buy the assets at a very small amount at the end of the lease term, at a very small amount, at a very inconsequential amount. So when such is available, I mean, that shows that the lessor knows that the asset is not coming back. He has transferred the risk and reward. And finally, where the asset is of a specialized nature, that only the lessee can use it without substantial modification. That only the lessee can use it without substantial modification. This is also an indicator, because where the asset is an asset that is specialized, that only the lessee can use it without modifying, that means the asset is not coming back. Class, you have to know these 5 points, because majorly all of these has to be available for the most of it, at least 4, for you to know that this is a finance lease. Now, when you have a finance lease, how do you then account for a finance lease? So let's quickly go through how to account for a finance lease. Then we'll look at for an operating lease. Then we'll solve questions on those 2. So you see, a finance lease, you should have noted that the classification of leases into finance and operating lease is only looked at from the standpoint of the lessor. The lessee don't look at that. The lessee just recognize right of use asset and lease liability. It is the lessor that needs to understand the class of lease. You need to understand that. So since a finance lease is that in which the lessor has transferred risk and reward is that in which is very close to the lessor has sold the asset. So in accounting for it, the first thing that will be done is to derecognize the assets. You will derecognize the asset. When it derecognizes the assets, it will then recognize what we call, it will recognize a lease receivable or a net investment in the lease. You can call it any of them, lease receivable or a net investment in the lease. That is what you recognize. And you know that when you want to derecognize an asset is a debit balance. When you want to derecognize it, you most likely credit it. Then you come and debit this lease receivable. But this lease receivable or net investment in the lease, how do you value it? How do you measure it? At what amount do you put it in your books? So the lease receivable from the name is the money, is the rent that the landlord is expecting, that the lessor is expecting. So you will measure it at the PV of unpaid lease rentals. The PV of unpaid, you will measure it at the PV of unpaid lease rentals you will now also add PV of unguaranteed residual value. When you add these two together, whatever you get, that is what will represent the net investment in the lease. This is a net investment in the lease. PV of unpaid lease rentals. And this makes sense. This is like all the rent you collect. That is what he's expecting. That is his lease receivable or net investment in the lease. He will now add PV of unguaranteed residual value. So the thing here is which one is unguaranteed residual value? So you see, being a lessor is believed that the residual value of the asset should belong to him. That is, after the lease term, whatever is remaining of the asset, which is a scrap value or a residual value, should belong to the lessor. So the way it works is that this amount, this residual value, will have been monetized by the lessee, meaning that the lessee would have told the lessor that, okay, for this residual value, I'm guaranteeing you a certain amount, maybe 50,000. That's the worst case. That after the lease term, don't worry, I will give you 50,000 as the scrap value of the asset. I will give it to you. So they always agree that upfront. So that one, we call it guaranteed residual value. Guaranteed. Because that is a residual value that the lessor knows it. He knows it. And in fact, that guaranteed residual value, we will usually include it as part of the unpaid lease rentals because it's part of the receivable of the lessor. However, in some situations, the lessor might believe that he can get much more than the lessee is guaranteeing. So if the lessee is guaranteeing a residual value of 50,000, the lessor can say that, no, now, asset should be able to go for 70K. So the lessee will not argue. The lessee have said, me, I'm guaranteeing 50,000. So if you're able to sell it for 70K, fine. Fine. That means you are freeing me. But I'm guaranteeing you 50K. So where this unguaranteed is coming from is the difference between how much the lessor believes he can sell this asset, like the 70K, minus the portion that the lessee has guaranteed, which is 50K. So there is an unguaranteed part of 20K. It has to come here because it's part of the expectations of the lessor. Even if it's not realistic, it's part of his expectations. And that is why we are having PV of unguaranteed residual value. And the reason why we have PV, that is present value, is because it's a future value. So we need to discount it to present value. So when you add these two together, you will get the lease receivable. And this is done at the commencement date. So what happens at the end of the year? So at the end of the year, what happens is that the lessor will receive rent. Abi, he will receive rentals from the lessee. And when he receives rent, you know that money will come in. He will definitely debit bank. Do you know what he will credit? He will simply credit this lease receivable up here. And he's crediting this receivable because his receivable will be reducing at every point in time where he's collecting rent to be reducing like that. Also, there will be unwinding of discounts. There will be unwinding of discount. Don't forget, whenever we do present value, we need to unwind the discount. We need to unwind the discount at the end of each year. And since we are unwinding the discount on an asset, we are going to unwind it with finance income. Unlike for liability, when we did it with finance costs, this one will credit the finance income. Do you know what will debit? The lease receivable to increase it. So all this I've done now, usually I can do it in a schedule. I can do this lease receivable in a schedule. I can just say balance brought forward, which is this one, this one here. What it does at the commencement date. I will add finance income, which is this unwinding of discounts that I debited to lease receivable. The other leg goes to finance income. You didn't even ask me where. It goes to POL, my POL. Then the lease rentals, the rent the landlord is collecting, which is this one, the rent that I credited to lease receivable. Then the balance is my lease receivable at the end of the year. At the end of the year. So basically, it's this schedule you will most likely do in the exam, but to know this double entry is very, very okay for you. And that is all about accounting for finance lease. For operating lease, sorry, do you have any question, please? Before I move to operating lease, then we solve questions. Any question, Bidemi, Cyril, Pascal, Chris, Tintin, any questions? Okay, that means it's all clear.
Not from my end, sir.
Okay, good. Now, for operating lease, you see, for this one, the lessor did not transfer risk and reward. He didn't transfer risk and reward. So the asset still remains in his books. He won't touch the assets. Even though he has leased out the asset, it remains in his books. He won't touch it. It's just there. So the only accounting issue here is just the rent. Just the rent. Rent is collecting. You just need to recognize it to P&L. However, under operating lease, you see, the rent received should be recognized to profit or loss on a straight line basis. On a straight line basis over the lease term. That's the technical thing here. Recognizing these rents on a straight line basis. And when we say straight line basis, we mean that it should recognize equal amount of rent every year. It should recognize equal amount of rent every year. So if the amount is receiving per year is unequal, what goes to P&L should be on a straight line basis every year, equal amount every year. Equal amount every year. That is all for accounting for lessor. But one more thing before I close. There is usually a type of lessor that we call, please pay attention to this so that you will not get this confused. We call that lessor manufacturer or dealer lessor. We call it manufacturer or dealer lessor. You see, this manufacturer or dealer lessor is a lessor that leased out an asset. And that same asset, he also sells it. He also sells those assets. He also sells those assets. He leased it out. He also sells them. It's just like somebody that sells car. He has a car lot. He sells cars. For whatever reason, maybe sales are not coming as fast as possible. He rented, he leased out one of those cars. He leased out one of those cars. Car that ordinarily he should sell. Where I'm going is that lessor in that type of situation, we call him manufacturer or dealer lessor. Yes, he has leased out an asset. And if he has leased out the asset under an operating lease, that one is not a problem. He will just use this accounting that we learned here. But if he leases it out under a finance lease, where he will need to derecognize the assets and recognize a lease receivable, he does all of this that I've taught you. He recognizes all of this. But the key thing here is this. This manufacturer or dealer lessor says if he leased out this asset under a finance lease, which almost translates to selling the asset, because finance lease is as good as sold, if you remember the indicators. So the standard says that in addition to doing this lease receivable and the rest, he says he must assume that he has sold the asset. Because ordinarily that's what you do, you sell the asset. You now list it out under finance lease. Yes, you do all of these that I've taught you, this receivable. At the end, you do all of that. But you must assume that you have sold it. And when I say assume that you have sold, it means that it needs to recognize sales. It needs to recognize sales and also cost of sales in its P&L relating to that asset. It needs to recognize an actual sales that, okay, I've sold this asset. So in addition to recognizing net investment in the lease or lease receivable, he must also recognize sales minus cost of sales. That will give him a gross profit. He must recognize that. So the key question is that how much is he going to put as sales? Very easy. It could either be the normal selling price, that if he was going to sell this asset, how much would he have sold it? We call that fair value. Or since he's leasing it, how much is he expecting to get over the lease term, which is this net investment in the lease? That is what he's expecting to get. That could translate as the sales. But you see this PV of unguaranteed residual value, we cannot put it as sales. Even though it's part of what he's expecting, but IFRS 15 will frown against recognizing an unguaranteed residual value as sales. Because if you remember what I taught you in IFRS 15, that anything that goes in as sales must be consideration expected from the transfer of promised goods or services. This unguaranteed residual value is not a consideration expected. Who are you expecting it from? You don't even know. It's only this one that you're expecting from the lessee. This one, you are just hopeful that you might know. That cannot go as sales. So usually, for sales, you're only going to compare the fair value with the PV of unpaid lease rentals. Only just this one. That's what looks more like sales. So the idea is this. The standard says if it's a manufacturer or a dealer lessor, he also needs to recognize sales and cost of sales. So what he recognizes as sales is going to be either the fair value or the PV of unpaid lease rentals. It picks the lower of the two. It picks the lower of the two. The lower of fair value and PV of unpaid lease rentals. While the cost of sales is going to be the cost or carrying amount of the assets minus PV of unguaranteed residual value. So by the time it does this sales minus cost of sales, it gets a gross profit. But see, there's something around this cost of sales. Why are you deducting PV of unguaranteed residual value again? Why? There's really no reason, really. The only explanation is that this PV of unguaranteed residual value ordinarily should have been added as part of this. But since IFRS 15 says that unguaranteed residual value is not something that you can consider as your sales, so you cannot add it to sales. So to enable it still have the same impact on profits, if you cannot add it to revenue, to enable it to have the same impact, just come and deduct it from the cost. It will have the same impact. Look at it. This is what I'm saying. Let's say you have a sales ordinarily of 10, and you have a cost of sales of, let's say, 7. You know, if you deduct this, you get a gross profit of 5. But let's say there is 2 naira income. There's a 2 naira that ordinarily, if you have added it to these sales, if you add this 2 naira to sales, no, this one, 10 minus 7 is supposed to be 3. So let's say there's a 2 naira. Ordinarily, if you add this 2 naira to this 10, it becomes 12 naira. If you take this, if you take away this 5, this 3 becomes, if you take away this 7 cost of sales, this 3 becomes 5. But we are saying you cannot add these 2, that these 2 cannot qualify as sales. To enable us still have our 5, just come and deduct it. I mean, if you cannot add it here, just come and deduct it from the cost. The cost becomes 5. 10 minus 5 still gives you 5. So we're only playing around with this PV of unguaranteed residual value. Since we cannot add it as part of our sales because of IFRS 15, and just come and deduct it from here. Just deduct it from here. Okay, now that is all around accounting for lessor. That's everything now. So let's ask questions then. If you don't have any questions, let's solve a few questions. Then look at the next thing to do. Anybody? Okay then. Let's solve questions. Let's look at this illustration. Illustration 5. This one says a lessor enters into a 3-year leasing arrangement commencing on 4th January 2003. Under the terms of the lease, the lessee commits to pay 80,000 per annum commencing on 31st December 2003. A residual guarantee clause requires the lessee to pay 40,000 or 40,000 less the asset's residual value if lower at the end of the lease term if the lessor is unable to sell the asset for more than 40,000. The lessor expects to sell based on current expectations for 50,000 at the end of the lease. The interest rate implicit in the lease is 9.2%. The present value of lease payments receivable by the lessor discounted at this rate is 232,502. Required, show the net investment in the lease from 4th January 2003 to 31st December 2005 and explain what happens to the residual value guarantee. Okay. So for this question, we have a lessor that enters into a 3-year lease that started on 1st January. He will collect 80,000 per annum from the lessee. And the lessee guaranteed the residual value of 40,000. I think I explained this earlier. He guaranteed the residual value of 40,000. But the lessor believes he can sell the asset for 50,000. Look at it. The lessee guaranteed the lessor 40,000. But the lessor believes they can sell it for 50,000. That means that in this case, there will be an unguaranteed residual value of 10,000. So they give us the interest rate implicit in the lease of 9.2%. And they also give us the present value of lease payments receivable at 232,000. So we are asked to show the net investment in the lease. Like I've taught you, the net investment in the lease, which is done at the beginning or at the commencement of the lease, is simply the PV of these payments receivable which they gave us as 232,502. You add PV of unguaranteed residual value. The unguaranteed residual value is 10,000, which is the 50,000 minus 40. Then you simply discount it to present value using this 9.2% rate, 1.092 raised to power minus 3. That minus 3 is like the lease term. So, and the unguaranteed residual value is payable at the end of the lease term. So, it's a future payment. We discount it to present value. So, we have minus 3 since the lease term is 3 years. If you punch this on your calculator, you get 7679. And that's the unguaranteed residual value. If you add that to this PV of lease payments, you will get 240,181. And that's the net investment in the lease at the beginning of the year. At the end of the year, starting from the first year, as computed earlier on, the value of the net investment in the lease at the beginning is 240,181. We are going to add our finance income at 9.2%. So if you get 9.2% times 240,181, it's going to give you this 22,097. Then you can deduct your lease income of 80,000. When you take that away from the 262, it brings it down to 182,278, which are going to carry to next year. Then you apply the 9.2% again on that 182,278. It gives you 16,770. You add that together, you have 199,047. You take away the lease income, you get 119,047, which you're going to carry to next year. You apply 9.2% on that also, it gives you 130,000. You remove the 80,000, brings you to 50,000. You see, the balance of this 50,000 is the residual value. Is the residual value of the asset. You see, this residual value, as we were told in the question, the lessee has guaranteed him 40,000. So even if he's unable to sell this asset at all, he will get 40,000. The lessor will get 40,000. But let's say he's able to sell this asset for, let's say, 45,000. That's good for the lessee. It means that the lessee won't have to give him anything because he has already gotten 45. And if he's able to sell it for like only, let's say, 30K, since the lessee has guaranteed him 40, that means the lessee would have to top it up by additional 10, just so that he gets 40. I hope you are getting the idea. So that is all about this question. The other thing is this. In the exam, you need to know what goes to P&L. And from this table, the only item that goes to P&L here is the finance income in each year. While the balance at the end goes into your non-current assets as lease receivable or net investment in the lease. Or net investment in the lease. Okay. So that is all for that question. That is all for that question. Is it understood? Guess it's a bit straightforward. Leasing is mostly straightforward. There's another question here, which is, I won't solve this one. It's just the same thing as that first one that I did. There's no difference there. So I would urge you to try this. Solution is there, so it's quite straightforward for you. Okay, I explained manufacturer or dealer lessor earlier. Okay, let's put a figure to it. Let's see if you still remember. It says that a manufacturer lessor leases out equipment under a 10-year finance lease. The equipment costs 32 million to manufacture. The normal selling price of the leased asset is 42 million. And the present value of lease payment is 38 million. The present value of the unguaranteed residual value at the end of the lease is 2.2 million. Okay, with this first paragraph now, if you look at the first sentence, the question told us that a manufacturer lessor. That means that this lessor is a manufacturer or a dealer of that item. And in addition to determining net investment in the lease, you must also compute like a gross profit. You must determine revenue and cost of sales. And how do you do that? Revenue, I told you, is the lower of the selling price and PV of these rentals. And from here, from the second or third sentence here, they said the normal selling price of the leased asset is 42 million. And the PV of lease payment is 38 million. The lower of the two is the PV of lease payment of 38 million. That means the sales is 38. The cost of sales is, we said, is the cost or carrying amount of the assets minus PV of unguaranteed residual value. The cost is 32 million. In the last sentence here, they said the PV of unguaranteed residual value is 2.2. So if we do 32 million minus 2.2, that will give us around 29.8. And that will be our cost of sales. And that is all. When you do sales minus cost of sales, it gives you your gross profit. Also, you will determine your lease receivable. I can easily get my lease receivable, which is the PV of lease rentals. The PV of lease rental is this 38 million. And I will also add the PV of unguaranteed residual value, which is 2.2 million. So that will give me 40.2 million. 40.2 million. So the only additional thing for manufacturer or dealer lessor is just determining that sales and cost of sales. The net investment in the lease is the same as the normal lessor accounting. I also explained operating lease. And I told you that this is recognized to P&L, that is the lease income to P&L on a straight line basis. Look at this illustration 7. They told us that a lessor leases a property to a lessee under an operating lease for 5 years at an annual rate of 100,000. However, the contract states that the first 6 months are rent-free. It says the first 6 months are rent-free. So, ordinarily, if not for this last sentence that says that the first 6 months are rent-free, this we should have it should just be a scenario where we recognize 100,000 to P&L every year. And that would have achieved recognizing rental income to P&L equally on a straight line basis. But since they told us that the first 6 months is rent-free, that goes to show that in the first year, we are only going to get 50,000, not 100,000. Then in the subsequent year, we'll get 100, 100, 100, 100. And we cannot go ahead and recognize just 50,000 to P&L in the first year and recognize 100,000 in subsequent years. That will be against the principle that says that you must recognize lease income on a straight line basis over the lease time. So the only way for us to do it, to achieve recognizing the lease rental on a straight line basis, is for us to look at, okay, how much rent can we recognize to P&L per annum? The easiest is for us to look at, okay, what's the amount receivable over the lease term? How much is left? We then spread that one equally over the lease term. And from the above question, the amount receivable here is that in year one, I'm only going to get 50,000. From year 2 to year 5, I'll be getting 100,000. So in total, that is 450,000. If you divide this by the lease term, we get 90,000. So is this 90,000 that we are going to recognize to P&L every year? Every year. That's what we're going to recognize to P&L. But when you recognize this 90,000 to P&L in year one, for example, now, how much are you going to receive in year one? 50,000. They will be out of balance somewhere. Something will not balance. You recognize 90 as income, but you received 40. There will be a receivable. In fact, in year two, you know you will still recognize 90. But how much are you going to receive in year two? 100. Out of balance. That means in the exam, you can't just say, okay, recognize 90,000 to P&L and you are looking. You must be able to recognize a lease receivable at the end of year one of 40,000. In fact, the double entry for this 90,000 is, because this is not what you receive, you put like a lease receivable and you're going to credit your income, P&L. So the way this lease receivable would work is like this. You have a lease receivable. Let's say this is year one, okay? Let me not, this is it here. Let's say this is year one. In year one, let's say the balance is 0. Let's say the balance is 0. You debited the lease receivable with this 90,000. The 90,000 will recognize to P&L. And you would receive 50,000. That means at the end of the year one, there will be a receivable of 40 that will go to non-current assets. We carry it to the next year. We recognize just 90,000. We receive 100. Remaining 30. You carry again to next year. You recognize 90. Receive 100. Remaining 20. You carry it forward. You recognize 90. You received 100. This is the balance. You carry it forward. You recognize 90. You receive 100. Then everything will nil off eventually. See, the core of operating leases is not always more than this. It's never more than this. But you need to be able to understand that what you will be recognizing in P&L most times will be different from what you will receive. So there might be a lease receivable somewhere. that you need to recognize at the end of the year as asset. As asset. Okay, so that is all for lessor accounting. That is all for lessor accounting. Do we have any questions? I'll be sending you some questions. I've already sent you some assignments on impairment. I sent you another.
Unwinding discount.
What is it?
Unwinding of, I have a question on unwinding of discounts.
I ask,
The
please.
entries. Um, like the entries. Like, can you run us through that again? And
Okay.
also the manufacturer and dealer listing.
Where did I write it earlier when I was explaining it? Okay. See, look at it. Unwinding of discount. I said, because this lease receivable, you discounted it to present value. So anytime you discount to present value, you need to unwind that discount. Because when you discount to present value, the amount becomes smaller. As you move through time, you need to find a way to increase that amount so that when you get to that future date, the amount would be that future amount that you discounted earlier. So you do that through unwinding of discounts. We also did this in lease liability as well. So for lease receivable, you do that with finance income. So you credit the finance income to P&L, you debit lease receivable. So that's the whole idea of unwinding. So in accounting, anytime we do present value, you unwind the discount every time. Every time. So Pascal, did I answer that? Well, that's that. And for the manufacturer or dealer lessor, I said is just this one is just where the lessor is a manufacturer or that item he leased out is the item he sells ordinarily. He sells it ordinarily. So he now leased it out. We are now saying that, okay, he's a lessor, yes, he does all the net investment in the lease that we have taught you. We are saying that in addition to that, he must also determine a gross profit. He must assume that that item he actually sold it by recognizing sales and cost of sales. What he recognized as sales is the lower of fair value or PV of unpaid lease rentals. What he recognized as cost of sales is cost of carrying amount minus PV of unguaranteed residual value. It was this PV of unguaranteed residual value that most of you might not find easy to understand. And I told you that is because we could not add it here. Ordinarily, what should be in sales should be net investment in the lease, meaning after you have added PV of unguaranteed residual value to this. But IFRS 15 will frown against adding items like unguaranteed residual value as sales. So you cannot add it here. For it to still have the same impact on your gross profits, just come and deduct it from here. And I give you a scenario like this. And I use this illustration to demonstrate it. This very simple illustration here, so that you can see it with figures. So that was all we explained on that. Okay, I hope I'm able to answer your question.